I can't predict recessions. If you guaranteed me there would be a recession next year, I would be buying and selling the same securities I'm buying and selling today.
With the 2024 recession approaching, Warren Buffett's strategies offer a way to make money even when times are tough. His advice brings hope in the face of economic uncertainty. He shows us a different path to financial success, pointing out an opportunity within the chaos. Following his wise teachings will lead to a chance for growth during the recession. In this video, we'll explore Warren Buffett's advice on investments and how to take advantage of a recession. As interest rates go up and talk of recession grows, many folks are worried about what this might mean for their money and their future. People have been talking about the possibility of a recession for more than a year, and it doesn't seem like it's going to stop anytime soon. Over the past 3 months, the stock market hasn't been good for investors in general. The main S&P 500 has dropped by 4.3% as of November 2nd, despite the recent rally at the start of November. The NASDAQ Composite Index has also fallen by 4.9% during the same time, with investors losing interest in previously popular technology stocks. The economy's mixed signals show that people are unsure which way the stock market will go. After every economic recession or stock market crash, there's usually an even stronger recovery that can double prices within 1 to 2 years. A recession often leads to lower wages, less confidence in spending, and lower values for things like stocks, food, energy, and services. Looking back at history, during recessions, bear markets tend to do even worse, dropping by an average of 34%. Some real estate markets, especially in Florida, Arizona, Idaho, and Southern California, are at risk, with possible drops of up to 30% from their highest points. It might take around 2 years for these markets to stabilize. However, for those interested in buying or investing in property, this downturn could be a good chance to find attractive deals. Looking at history, we see a repeating pattern where a bear market is usually followed by a bull market. On average, the market tends to bounce back by 60% within 2 years after hitting its lowest point. This shows the potential for making profits by investing during a market downturn. In every historical case, the market has always bounced back. Despite what many think, economic downturns are a golden opportunity to create wealth. When the economy is down, things become more affordable, which can be a chance for smart investments at a discount. This means that people can buy things like houses or stocks at lower prices. It's also a time when smaller companies might have a better chance to grow because bigger companies aren't doing so well. After the tough times, there's usually a better period called a bull market where things start to improve. This means that people who invest wisely during the bad times can make a good amount of money when the good times come back. So even though tough times can be scary, they can also be an opportunity to make money and grow. This brings us to Buffett's famous saying, "Be fearful when others are greedy, and be greedy when others are fearful." This suggests that during times when people are scared to invest money, such as before or during a recession, you can use the opportunity to buy stocks and other assets at lower prices. This strategy allows you to benefit when the market eventually bounces back. According to Warren Buffett, negative news is a great thing for investors. It gives them the chance to purchase a part of America's future at a lower cost. However, what you shouldn't do is spend time trying to guess when the economy and stock market will get better, as even experts like Buffett can't predict that accurately. Instead, focus on taking advantage of the opportunities that come your way during challenging times. Warren Buffett has turned Berkshire Hathaway into one of the biggest companies globally and has earned a massive $100 billion fortune in the process. This success makes him a valuable source of knowledge about the economy and finances. Buffett thinks that the most important thing for a business is to have something that gives it an edge over others, like, a competitive advantage. This helps the company keep its customers even when other companies are trying to compete. This advantage often comes from the ability to decide on prices. In Buffett's company, you can see this with Apple, which can choose its prices because of its strong brand and the challenges people might face if they want to switch from using Apple products to using products from another company. He thinks it's smart to invest money when things are not going well, and people can learn from what he does. Sometimes Berkshire buys more stocks and other times it sells some, but it always puts money into stocks, no matter if the stock market is doing well or poorly. This means that investors should be excited about the chance to buy stocks when prices are low, as long as the price is reasonable. Buffett likes to use something called discounted cash flow models to figure out how much a business is worth. These models look at how much money a business might make in the future and how much that money is worth now. In Buffett's words, the stock market shifts money from active traders to patient investors. He sells stocks if his original reasons for investing change, but he might also reduce his holdings to have money available for better investment prospects. Investors should plan to hold stocks for the long term, regularly reviewing their reasons for investing to ensure the stock remains a valuable asset. Warren Buffett suggests that most people should keep buying an S&P 500 index fund. This plan helps spread your money across many big businesses globally, which Buffett thinks will do well over time. The best part is, it doesn't require much effort. Buffett even believes that regular folks who don't know much about investing can do better than most professionals by simply buying an S&P 500 index fund now and then. History proves this too, as less than 8% of big investment funds have done better than the S&P 500 in the last 15 years. This means that many investment managers could have saved time and earned more for their clients by just getting an S&P 500 index fund. To prepare for a recession, it's a good idea to have enough cash available so you can make smart choices instead of being forced into decisions. While you might not be able to accumulate billions like Berkshire Hathaway, you can still avoid investments that might lock up your money. Make sure to have some cash saved up for when you come across good opportunities to buy things. Having money set aside can help you take advantage of valuable investments or purchases when they arise. It's like keeping some money in your pocket for when you need it. Another thing is to try spending less money on different things. This could mean buying fewer items or choosing less expensive options. It's about being smart with your money and making sure you don't spend more than you have to. In tough economic times, even strong companies can struggle, and their stocks can take a hit. However, as Buffett noted, this is usually temporary. Most big companies are likely to make even more profits in the future, so investing in them can still be a good idea. While many experts offer their research for a fee, following Buffett's advice means doing your research and avoiding investments in businesses you don't understand. Begin by reading about the company you're interested in. Look into its management, what it sells, and how it operates. Make sure you comprehend the product and believe it has a future in the economy before investing. Before you invest, consider if you would start the company from scratch if given the opportunity. Then examine the company's financial statements, usually found on their websites. Analyze their balance sheet, profit-loss statements, cash flow, operating costs, revenue, and expenses. Is the net profit increasing over the past few years? Assess if the company's debt is reasonable. Additionally, compare the company to its competitors within the broader economy. Focus on businesses that have the potential for growth and stand out, particularly in competitive sectors. Stay updated even after you've invested in a company. The economy changes, and your investment strategy should too. Also, don't hesitate to take a break from active investing. As Buffett suggested, owning an S&P 500 index fund can be the best choice for many people. It's best to continue with your regular investment approach. Avoid sudden changes in your investment strategy, whether it's a sudden halt or excessive stock buying. Stick to buying good businesses managed by people you have faith in at reasonable prices. Stick to this strategy consistently over time. Instead of putting all your money in low growth options like risk-free checking and savings accounts before a recession, consider other options. Buffett suggests that equities will likely perform better than cash over the long term, possibly by a high margin. Although recessions can sometimes last for different lengths of time, they always come to an end. On the other hand, the stock market generally goes up over many years. We saw this happen after the Great Depression in the 1930s, the tough economic times and high prices in the 70s and early 80s, the Great Recession from 2007 to 2009, and the challenges brought on by the COVID-19 pandemic in recent times. So even when things seem tough, history shows that the economy and the stock market usually find a way to recover and grow again. If you notice your investments decreasing before or during a recession, don't worry. Keep in mind what Buffett says: the stock market always recovers. History has shown this many times. So even if things look bad now, they will likely get better later on. Trust that the market has a pattern of bouncing back, and stay patient with your investments. If you build on the foundation of his insightful strategies, you can navigate through the uncertainties of the 2024 recession. Remember the importance of holding on to cash for promising opportunities and being cautious with expenses. Buffett's emphasis on investing in solid, understandable businesses at reasonable prices echoes the idea of a balanced approach. During tough times, stay patient and remain confident in the market's eventual recovery, just as history has consistently shown. If you enjoyed this video, like and subscribe to this channel for more valuable content, and thanks for watching.